Good morning, everybody. I'm Nastassia Arendse, and I'm delighted to welcome you to the Financial Mail Private Lounge Live. Our topic today is going to be institutional investing in a post-COVID-19 world, sponsored by IRESS, JSC, and CFA Society South Africa. Now, following on from the 2020 Financial Mail Top Analysts Awards, which this year moved to an online experience, we decided to add an additional element, which is this one, where my panel of experts will discuss the 2020 Top Analyst results. We'll also unpack in greater detail what's happening in the industry. We'll talk about the trends as they relate to the current results and what to expect in a post-COVID environment. So we do appreciate you interacting with us, and you can do that by talking to us and asking your questions in the live chat room. And you can also provide us with feedback, which is next to the chat box. You'll be able to find it there. And we appreciate that at the end of the session. I'm going to do my absolute best to get through as many questions as possible, and to also make sure that this conversation is as interactive as possible. But before we get into the actual discussion, and before I actually introduce the rest of my panelists, let's welcome Rob Rose, who's the editor of the Financial Mail.
Hi guys, thanks for joining us today. It's going to be great. It's the first one of these we're doing, even though we've been sponsoring the Analyst Awards for many years. I want to say thanks so much to the guys we partnered with, Intellidex and Stuart Theobald, who again has done a fantastic job. To the CFA Institute, and you'll hear from Narina just now, IRESS and the JSE. It's great to have you guys on board, and it makes this kind of thing possible. Just as a short word from us, I mean, essentially, analyst research, like the media, has had a tough few years. But I'd like to believe, I obviously would like to believe this, that the age of expertise is back, as Angela Merkel said, which should be good for both of us. It's better than the anything goes kind of, who needs the experts view of the last few years. And I think that it illustrates that at a time when the market values are shooting up at the moment, and have shot down in March and April, the value of the people who can see through this and tell you what's going on has never been greater. The limitations of just blindly buying an index rather than knowing what you're talking about with specific stocks has never been clearer. If you look at things like Sasol, for example, up 80% since March, but yet ABSA is down 8% in that time. Naspers is up 11%, SPAR is down 11%. So I think that the value of specific research that tells you what's going on has never been greater, and that's obviously, I'd like to believe that. For us, the FM, it's been a strange COVID period. We've never had more readers than now. We've had a 400% increase in readers on our website, for example, year on year, which is fantastic. But the issue is the economic model that underpins online media. But to me, I see it as a very positive thing that there is a demand for expertise and explanation of how the world works. And I think that that's what, if anything, this award demonstrates to us. So please join us for this next hour and enjoy it. Learn a lot from these guys. They're all very smart. And let's do it again next year. And now a word from our sponsor, the JSE.
We woke up one morning and the world had changed. In an instant, our lives were filled with new words, new images, and new things to fear. But the best parts of us remain. What makes us human endures. We solve problems, we learn. We innovate, we cooperate, we have compassion and we have patience. We make each other brave. If there was ever a Tumamina moment to be brave together, this is it. #Trade for Solidarity is a JSE initiative bringing together the capital markets ecosystem to support South Africa during this time of need. The JSE is humbled and grateful to market participants across the trading community for uniting to pledge trading revenues in support of those in need. Trading for solidarity, trading for unity, trading for South Africa. Join us.
Thank you so much to Rob sharing his, words of welcome. And of course, now we're going to get into the actual conversation. And to do that, I'd like to welcome my panelists, starting off with Stuart Theobald, who is the chairman of Intellidex. We're also going to have Mark Termors, who is the head of equity research, looking at institutional equity research at Standard Bank. And then also Norina Visser, president of the CFA Society South Africa. Thank you so much, everyone, for joining us. And I'm absolutely happy to be having this conversation with you. And just to encourage our viewers to continue, interacting with us on the chat, I'm going to get through those questions as well. And just to make sure that, this entire discussion is just as meaningful to you as it probably will be for me as well. But just to, set the scene a little bit here. I mean, when we started off in the beginning of the year, a lot of people had assumptions about what they thought 2020 would be, predictions. You had all kinds of reports about what to expect in the first quarter or second quarter, all kinds of full year analysis. And then we get to a point where we are in this sort of COVID-imbued haze and we have no idea what's going to happen. Everyone talks about a new normal, and we're still not sure what that new normal is going to be. And when you get to, trying to predict things, it was difficult before. Now it's going to be even more difficult. And I guess this is what Rob was alluding to in his, welcome address, saying that, the need for good quality research is going to be so important, probably now more than ever, especially as we try and navigate our way through this. Not sure what's going to happen, be it from a, China-US point of view, whether it's going to be from a vaccine that may come off, if we're lucky, by November. And then we also have US elections that are also going to be taking place around about that time. And Stuart, perhaps we can start off with you. I mean, I had a look at the actual results in depthly, looking at how, I suppose, call it the way that it's changed in terms of the number of entries, etc. But perhaps you could give us some insights into, the methodology of putting a research like this together and the factors that may have affected the results.
Sure, Nastassia. It's effectively a market research exercise. We're going out to a customer base and asking them for their views on their service providers. In this case, the service providers are largely investment banks and other researchers who are providing research insights to investment decision makers. So everybody from the managers of large, collective investment schemes through to managers of pension funds and other kinds of assets rely a lot on research that's provided to them in order to decide how to allocate their portfolios. And that research function is really important to the efficiency of financial markets. The evidence is clear that the better the quality of research, the more research being produced, the more efficient financial markets become. And that's a public good that ensures that the cost of capital is lower in an economy. So it serves a really important role in that regard. As a market research exercise, what it involves functionally is taking an online questionnaire we take out to all asset managers and other institutional investors and ask them to complete it with detailed views across 40 different research categories. So there are analysts who tend to specialize in particular areas of the market or on particular themes. And we ask their clients to rank them. And the result is a highly competitive outcome of how those analysts are doing and what clients think of them.
Right. Mark, let's come to you. I mean, at this particular point, I saw when I looked at the categories and the number, the list of winners, Standard Bank, SBG Securities, right at the top. If I'm not mistaken, I would say it's 5 years in a row. Somebody sitting there who's probably following this whole, the results and the research over the years is probably thinking, well, Mark, what are you guys doing right?
Thank you for the question. Good morning to everyone. Of course, I'm very proud of the team of people that we have that established such a nice track record of 5 years being rated quite highly, #1 in the Financial Mail survey. First of all, I must say, I think the survey is of critical importance, I think indeed to market efficiencies to both the buy and the sell side. And one particular reason as well, that as brokers, we've seen actually a reduction in individual broker reviews that we obtain from our clients. So that's probably for various reasons. So if I go back in my own history, I can kind of recount that we received 15 annual or so broker reviews probably 7 years ago. And that has dwindled to about 3 or 4 individual broker reviews from some of the largest long-only fund managers in South Africa. So therefore, that then means that the Financial Mail survey provides therefore the most comprehensive review of what the buy side, and we're then talking about long only, also hedge funds, think about the service position and the value add from the broking community. And as always, I think it has remained paramount for the sell side to really focus on fundamental research and to really attempt to come up with high conviction investment ideas that make money for our clients. And ideally, of course, to be non-conviction as well. In addition to that, I think secondly, it has been very important to have a good service level provision to your clients. So we were fortunate with the Standard Bank platform to have invested in cloud computing, which then means that we were able to move to a home and remote work location quite quickly and quite seamlessly. So we've been able to contact our clients, share models, have regular conversations about the risks and the opportunities. So that has been critical. And the third element has been corporate access. So obviously in dynamic situations, as have been a result of COVID, there's been even more critical for us to connect policymakers and executives of the corporates to the investment community.
Right. Nerina, perhaps let's dig into your own history here. Mark was talking a little bit about his. How have you seen the industry change, especially as it relates to that importance that Mark spoke about of quality research?
Thank you, Nastassia, and thank you very much for this opportunity. It's a wonderful, I think, panel to be part of. Being an industry veteran myself, it's been amazing to see the evolution of the industry over the last decades. And I think we find ourselves now in a state where the professional excellence which CFA Institute ascribes to and that we promote amongst the analyst community also has never been more important than right now. And I think what we're finding with this type of survey, that at the top end, so the majority of the survey is really focused on the things that Mark alluded to so well. It is about the value add to the buy side, to the institutional market, in terms of having those good sets of research numbers, the conviction ideas, access to corporates and so on. We've tried to come in terms of really sort of honing the skills of the analysts in the Young Analyst of the Year award is really to focus specifically on your skills as an analyst. And so for me, it's been wonderful to see in that young analyst category in particular, where the assessment is so different than what is done for the overall top analyst awards, where it's purely done on the basis of the quality of the research that has been produced by the young analyst. So it's assessed by a team of CFA charter holders on an anonymous basis. So it's really about getting into the quality of the research, how those investment cases are presented, the value proposition that's in there. And I think once you've been able to hone your skills as a young analyst, that's when you can actually step up the professional ladder to say, right, now I've actually got to say, so what does all this mean? How does this fit into making good investment decisions? And when I look at the evolution of the industry, never has it been more important than right now to be able to actually take disparate information from different sources, assessing the quality of information that we have coming our way. We are flooded with information overload. To be able to be discerning and to actually evaluate the information that comes your way and put it together in a comprehensive value proposition and investment case for different types of investments has never been more important. And so I think think it's a very proud partnership for us as CFA Society South Africa to have been involved with the FM Top Analyst ranking over all these years, and one that I expect will remain an important one in the years to come.
Stuart, Narina's points are a nice segue into the discussion around the top small Black broker. I mean, talk to me about the conversations you may have had with industry about transformation and how the introduction of that category works towards that transformation.
Sure. Transformation has been a major topic for all of financial services for some time. I think in the institutional stockbroking market, it has appeared to move more slowly than other areas of the financial services market. And when one looks at the top analyst cohort, it has really struggled both in gender and race to more broadly reflect the country. So the top Black Brokers Award was a mechanism to support that transformation effort. The dynamics of the industry are such that one has several large institutional brokers who have significant resources and reach. And that gives them a kind of competitive traction in the market that's very difficult for new entrants and smaller firms to overcome and to try and gain some market share. And that's really been a constraint on transformation when it comes to encouraging small Black-owned firms from being able to enter and service clients in the market. So this introduction was a way to support that process, to recognize specifically small Black broking firms and those that are being highly rated by clients, to draw them out from within the overall sample and highlight those that are successful. There is a demand from the buy side to allocate more of their research spend to Black brokers, more of their research and execution spend. So this provides a mechanism to highlight Black brokers that are doing well, that are getting positive feedback from clients, to help drive that mechanism of transformation in the sector.
Right. The couple of questions that have come in through now actually relate quite nicely to this topic that we're having. And I think, Mark, you might want to take this one. And it relates to research, where one of the viewers wants to know how much research is now reliant on AI and machine learning as opposed to the human element and interpretation.
That's a very good question. I think in our fundamental research, I must say the majority still does not rely on AI. So it's very much the, let's call it reading and knowledge of the analyst about the sector, of what will happen with the macro environment and how that's pulling through to earnings and cash flow and how doing that to value that. Yeah, we've had substantial successes with using web scraping. So tools like Python, for instance. So there are certain analysts that have started employing quite successfully these AI and machine learning type tools to provide additional insight. Yeah, so examples would be where we used NASA data from satellites to look at heat intensity of urban areas in Africa, for instance, and by doing that, estimate what the economic growth rates would have been in urban areas. The other example would be to look at, for instance, very interesting, the price of jeans. So if a company claims that they are the lowest cost delivery of clothing in South Africa, we can then test that by web scraping and prove if indeed the jeans that that company offers are at 15 or 20% discount consistently compared to the competitors. Yeah, so increasingly we've seen AI being utilized to provide differentiated insights, but we haven't yet come to the stage where modeling, for instance, can be done in a machine learning version. That's still very much a human Excel type interaction.
Right. Narina, this question has just come in and it says, do you believe that the access to more data in real time is making analysts' jobs easier or more difficult? What do you think?
Also a very good question. And, I don't think it's making it either more difficult or easier, but it's definitely making it different. I think the benefit of the technology and the techniques that we can use in terms of assimilating all of this masses of data that we've got is that a lot of that can be automated, or it can be done via computer. And it allows the analysts, therefore, to much more apply themselves, look at the interpretation of those trends, the interpretation of the data, build the relationships with the companies within the industry, and so on. And I think that for me is really the best of both worlds, because technology and the models allow us to do in a much more automated and quick turnaround and consistent way the analysis of this flood of data, and therefore frees up the time of the analyst to spend time on things that only the human can do. And so for me, it really is the best of both worlds.
Stuart, your thoughts? I caught you smiling during that question.
Look, data deluge is a problem for everybody, and it's interesting how when the lockdown started, there was this kind of calm while everybody kind of tried to think through what the implications were, and then there was a wave of views and opinions, and it's been a challenge to sort through that and find the real insight. But I think that what's become super important is that fundamental research and dealing with uncertainty, and how one should deal with uncertainty in an environment like this has sort of risen to the top. We tend to, in pre-COVID times, in times of normal routine, focus on trying to anticipate the future by looking at the past, right? Most of our models are based in some way on previous market movements. And now we're faced with a situation of true uncertainty where we have regime change in the data. So all of the data that is historic is not very helpful in anticipating what's coming towards us in the future, because the world has fundamentally changed and the generating conditions of that previous data have now shifted. So the challenge for analysis is that you've got to have a different tool set, and you've got to approach it in a different way. We're now dealing with uncertainty, which requires going back to basics to understand causal change in an economic system and what kind of outcomes that causal change leads to. It's a really different skill set from using great amounts of data to try and model and anticipate trends, to basically extrapolate from what's happened in the past to tell us what's happening in the future. So for that reason, historic data, huge volumes of it, is of less use than it was to us 6 months ago. And now we've got to use different techniques that really require thinking about economic systems from the ground up and understanding the mechanisms and models. We use models to understand causal mechanisms to be able to anticipate the future. It's a really different type of approach to research, I think, that's become important.
Yeah. Mark, on the back of the uncertainty that Stuart's talking about, when you look at the trends coming out as a result of COVID, from an institutional stockbroking point of view, what are some of the trends that you're picking up?
First thing that we did, it's linking into what Stuart mentioned as well, is that in the beginning of the year, when COVID moved from an endemic to a pandemic, we first assisted investors with kind of analyzing what were the clear defensive stocks, right? So which companies would be resilient, which balance sheet cash flows could stand up, right? At least for a number of reporting periods. And that was the initial reaction, which I think was probably a kind of consensus reaction as well. We then quite quickly moved on in April, May to say, hold on, not many individuals will know how the macro environment is going to be impacted. We don't know yet how much oscillating waves of infections there may be, and when there's going to be an effective vaccine. Yeah, we did put certain milestones, flags in the ground of what we think could be a likely outcome. But we then said, let's look at 2022. So let's forget about actually 2020-21, because we don't really know what earnings are going to be. But in 2022, it may very likely be that we're in some kind of normalized economic scenario. So we then had the base case and we had the bear case. And the bear case was the economy in South Africa 5% weaker than what it was in 2019. So you're really going to stress test which companies are going to survive, and then you run through a couple of, let's call it, investment buckets. So we defined the first bucket to be mispriced defensives and fallen angels. The second bucket was quality cyclical companies. And the third bucket was unloved, unpopular sectors like the banking sector at the moment and the real estate sector. And then we said, if you're able to look into 2022, which kind of companies would you then buy as an investor if you have the luxury to look post-COVID? And that then resulted in a very different stock selection and advice to investors than actually the initial Q1 investments that we had as proposal, which were many defensive companies, let's call it in telcos, would be one example, some of the consumer staple companies. So that was a very interesting exercise for us to go through, which I think has resulted in value to our clients as well.
Right. One of the other themes that's coming out as a trend that might probably be a lot more popular is surrounding ESG. And I'm wondering at this point whether the pandemic might be that seismic shift that we need, where ESG really comes to the fore, because we've already been talking about governance, we've been talking about environment, and now we're dealing with the social aspect of it. Nerina, your thoughts around the ESG landscape, particularly now?
Absolutely. There's no doubt that this is a very strong and growing trend, and one that I think is long overdue. And really, we do not see this as a separate exercise or as a separate trend, but really ESG principles and the consideration around ESG really should just be fundamentally part of your regular investment analysis process. I think in the South African context, for me, there's a much bigger need than just the almost the ESG sort of mantra that we hear, and that's really the impact that our investment can have in terms of a social economic impact really that it can have. And I think that's an area where I see the need for the biggest developments in our investment industry. I do think that we're still somewhat obsessed with the listed equity environment. I mean, if you only look at the FM Top Analyst rankings, for example, just look at the number of awards that are given in individual sectors on the JSE, and yet there's this vast investment environment and a need for much more in the unlisted space that we don't really focus on sufficiently. That's not to say that there's not a lot of work being done in this space, but I would like to see that in future we recognize a lot more of this, and also much like Intellidex this year has done in terms of focusing on the transformation and measuring and rewarding top brokers in the black space, that we also need to do a lot more of this in the unlisted space also, and especially where it can have a proactive, impactful impact on the socio-economic environment. You know, when you look not just at South Africa, where clearly the listed space has become a lot less relevant in terms of the follow-through into the South African economy, across Africa, this is also very much the reality. We know that the listed equity market is a very poor reflection of the investment opportunity set across Africa, and therefore we do need to actually hone our skills a lot more in terms of how do we analyze, how do we measure, and how do we actually present these as impactful investment opportunities to the allocators of capital.
Stuart, as Nerina speaking already, I'm thinking South African economy, I'm thinking socioeconomic issues and, you know, being able to drive growth or kickstart growth. And I can't help but go back to the debate that we've been having around prescribed assets. And I know you've written quite a bit about it from your perspective. Is perhaps impact investing what could work as opposed to being prescriptive about the ways that we need to be doing things to, you know, get growth going?
Yeah, it's an interesting debate. Look, South Africa has a really good financial markets environment. We're actually pretty good at mobilizing capital and investing it to drive growth. And there's lots of evidence for that. You know, the renewable energy program, for instance, raised over 200 billion rand in 5 years to fund development. So there's clear evidence that when the right kinds of investment opportunities are presented to the marketplace responds and mobilizes capital to back those. Now, the question around prescribed assets is, I think, misformed. If we have a pipeline of investable projects in infrastructure that can support growth in the country, that pipeline can be adequately absorbed by the investment market as it stands. The question is whether we have the pipeline. You know, the prescribed assets conversation can only really become a real one if there's a pipeline that somehow is not being funded. But there is at the moment just no pipeline. We talk a lot about infrastructure and the importance of investing in infrastructure as part of the economic recovery. But the fact is that there are no projects that are being taken to the market right now in order to raise funding. So I think I see the problem really on the supply side rather than the demand side. There needs to be much more work done in the development and supply of projects to the investment market. And then we'll see how the investment market responds. And in my engagement and research, it's quite clear that the investment market is capable of mobilizing large amounts of capital. So then the question is, why do you need prescribed assets? What would the objective be? The only answer to that is that prescription, as we saw it in the apartheid days, effectively enabled a discount in the cost of capital, right? By forcing funds to invest in a certain category of assets, you're forcing them to give up market yield that they could obtain if they just invested to optimize returns and risk, right? So it becomes a stealth tax on savers because returns are compromised. And then, you know, just as a question of economic efficiency, should we be taxing the savers through that kind of stealth tax? Does that make sense economically in an economy that really has too low a savings rate for its own good? Or should we really be focusing on raising taxes more through consumption taxes and using that to fund infrastructure? You know, those are the kinds of questions that come to light if we're going to be having a prescribed asset conversation. And every one of those questions, I think, lead to the answer no. Prescribed assets doesn't make sense.
All right, so then let's look at it from this perspective. And Narina, I'll kick off with you. When you look at the response that we've had over the past couple of months in relation to COVID, has it been adequate from either a government perspective and from a Reserve Bank perspective? And if not, what needs to happen or what should we be doing to make sure that the response is adequate enough? Because going into COVID, the economy was, you know, in shaky ground as it is.
Yeah, that's definitely a true comment, and I think certainly not just from the economic point of view, but I think even when you look at individual sectors and companies, it's also true that a lot of those that we are seeing that are finding themselves in dire straits at the moment weren't necessarily caused by COVID, but the decline has been accelerated by COVID. So coming to your question in terms of has the policy response been adequate? I think we've seen very good policy response, but we haven't seen traction in terms of the implementation of that policy. And of course, we know how large the holes in the sieve is through which the policy mechanisms have actually been disappearing into impactful areas of the economy. For me, I think what's been the shining light through all of this, I think, has been the Reserve Bank and the extent to which they've been able to ensure the functioning of markets. And when you go back to March and you look at their interaction, especially in the bond market, where it was not as we might think in terms of quantitative easing in the US Fed type of context, but rather one of ensuring liquidity, ensuring normal functioning of markets, which I think has been incredibly important. Has there been sufficient, money being pushed into the system? I think actually private individuals and to some extent corporates, I think, have been a lot more impactful in terms of what they've been able to achieve rather than the formal policy responses from government. And I think it is unfortunate, but I think it is testimony to the fact that government is never the most efficient allocator of capital. That really is a private market function. And it's good to see where individuals and private companies are stepping into this requirement, into this void to some extent, but I would have preferred to see much more of an enabling environment coming from government rather than sort of headline grabbing big number announcements that are being made with relatively little positive impact all the way down the value chain.
Mark, your thoughts?
My first point of view was I don't think there's an imminent threat of prescribed assets. And I think we need to make a difference between the Treasury's proposal to make changes to Reg 28, which are more allowing investors a wider investment opportunity across different asset classes, but it's not a forceful investing in certain prescribed assets. I think it's very interesting to touch on a few dynamics coming together. The first dynamic being fiscal constraints across African governments, and secondly, allowing therefore let's call it crowding in of the private sector in public-private partnership opportunities. And that creates what Nerina spoke about, is impact investing opportunities. So if I look at our kind of tracking of possible projects in South Africa only, we get to a number of $30 billion of where government is proposing public-private partnership. And that ranges from clean energy, it's roadworks, waterworks, water reticulation. So there's an enormous amount of potential, I think, that will come to the market. And we've seen the announcement, I think it was last week or the week before, of a 340 billion rand infrastructure program, which is about 20% of what South African government would normally spend. And I do think that's absolutely critical, that if you look at South Africa's history of economic growth, it's often kick-started, one by public sector spending on infrastructure, and secondly by a stronger mining commodity cycle. And it may well be that if we're looking 1 or 2 years ahead, we have low interest rates. So in other words, the government and the Reserve Bank have responded quite quickly with fiscal support, but also monetary support, that we have a very low interest rate. And at the same time, we're going to get this infrastructure investment occurring in South Africa, which is allowing the private sector to actually crowd in. And that could then avoid the necessity for prescribed assets.
All right, I'm just going to quickly take this and look at it from a global perspective. And I can see one of the questions, one of the viewers wants to know, then given what we're discussing, what is the prediction for global markets? Are we looking at a V curve, a U curve, or an L curve? And I'm going to take Nerina for that one because she has the biggest smile this morning on that. Which letter of the alphabet are you going with?
I'm not going for an alphabet soup. I think it's a way more sophisticated than that. As a mathematician by trade, I quite like the square root idea, but I think the consensus at the moment probably is mostly related to the Nike swoosh. So yes, certainly a short-term impact. The rate of the recovery after that is the one that is uncertain, and which I think at the moment is it's really just guesswork. There's no clear indication, as we don't even understand what the path of the virus and the impact of the physical lockdown would have on the world economy. I think what is quite different in terms of this compared to maybe the prior V-shaped recovery that we had in 2008 with the global financial crisis is that was very much a financial market impact. And what we saw is, yes, there was a V-shaped recovery, but the recovery was to a level of economic growth and activity significantly below what it was prior to 2008. What I'm expecting really this time around is that the recovery will be back to sort of pre-COVID trend path. It might take some time to get there, but because there is a lot more opportunity for evolution, for changing economics, for changing way of work, we will see significant losers in all of this, but there will also be significant winners in terms of this. So the shape of the recovery is not as important for me as the makeup of that recovery. Who will actually be able to come out of this? And if we look at it on a global context, there's no doubt that China and the Asian emerging markets will come out of that a much, much stronger global force than the US in terms of this. I think through President Trump's America First type of policies, what he is doing is he's actually reducing the significance of the US on the global stage on many different fronts. And the void, the gap that he's creating through that is very ably and very happily filled by the Chinese. And I think there's good and bad in terms of that, but I think what it does mean for us is that we need to understand the Chinese way of thinking, the Chinese way of making investment decisions also a lot better. We tend to be very Western and developed market focused in our way of thinking around economics and investments. And I think we need to bring much more of a developing and emerging thinking into the way that we approach our investment problems.
Right, I'm going to shift gears a little bit, and perhaps, gentlemen, you want to take on this one. I'll start off with Stuart. The question says, there's been an exodus of South African companies abandoning their investments on the continent. Has this surprised analysts, or has it been a long time coming, rather?
We're talking about exiting investments in the rest of Africa.
Yeah.
look, African markets are difficult, and many South African companies have really, suffered a bruising experience. But there have been success stories. I think this has been partly a learning process. As Marina, I think, makes a very valid point that we need to understand globally how the Chinese make investment decisions. And you can bring that same point to Africa, and that I think a lot of South African companies didn't really understand the economies they were going into, the sort of assumptions that South African environments are more or less the same as they find in the rest of Africa, and the same business models will work. And also, I think assumptions about deals. A lot of the problems that South African companies have faced is they've gone in and bought assets, only to discover that down the line that what they bought is very different to what they thought they were getting. So there was really failures of due diligence, failures of understanding the environment that they were going into, of really understanding what the outlook for those environments was. But we also now face a difficult period for Africa in the recovery process. That there's going to be significant challenges with, and as Marcus said, we fiscally constrained governments. Our own is one, but many across the rest of Africa with serious fiscal constraints that are going to constrain what kind of recovery. I think a lot of the recovery is going to be driven by the efforts of international financial institutions and multilaterals, and the kind of support they're able to bring to African markets. And we'll have to see what that looks like. I think for now, South African companies, there are always opportunities, and crisis brings opportunity. But it has to come with a lot of caution, and one has to really take on board the lessons of the last couple of decades of South African experience investing in the rest of the continent. That you really have to understand the local environment, and you really have to do your due diligence.
Mark, your thoughts?
I'd like to make 2 points. I mean, there's no doubt indeed that there are some highlights around particularly consumer companies extracting themselves again from South Africa. But I think there's many success stories as well. So the one that we want to highlight is, of course, the increase in foreign direct investment that we've seen, the recovery in foreign direct investment in Africa and also in South Africa. So if we focus on Mozambique, for instance, there's approvals of $19 billion investment in the natural gas and LNG infrastructure in Mozambique. That's probably going to accumulate to about $50 billion. And that could possibly have tremendous opportunities for South Africa to reduce its carbon footprint from coal-fired power stations if we're going to invest in transporting natural gas via pipelines to gas-fired power stations in South Africa. The other element is that a success story is the intra-regional Africa trade, which has outgrown South Africa's GDP tremendously, similar to our exports to Asia, and substantially outperforming Africa's exports to the US and to Europe. So if you tie that into the free trade agreement that has been signed a few months ago between the African nations, I think there's a lot of very positive developments as well, where South Africa needs to make sure, and its companies need to make sure that they position for these growth opportunities that will emerge from that.
All right. So the next question, and I think maybe we can get input from all three of you, relates to, but basically it says, how do analysts try to make an educated analysis in a time when whole industries can be shut down without a moment's notice? And in this particular case, the viewers were, using the example of the alcohol industry. Nerina, does that make things a lot more difficult for you when you don't know what's coming?
So Nastassia, I think both Mark and Stuart alluded to this already earlier on in this conversation. And I think that is the uncertainty associated with a near-term outlook is really the one that's very difficult to predict. So if you are talking about trading strategies, that's where you sort of start relying a lot more on technicals and because you don't actually even know what is causing the type of price action that you might be seeing. But when we start talking about investments and we're talking about a longer term, it's very important to look look through the current sort of turmoil that we've got, the uncertainty that we have at the moment, and try and identify longer term. Mark was speaking about 2022 sort of picture and 2023, and to say, what does that longer term outlook look like? And I think the focus much more in terms of not the specificities or the details of what will make a successful company or industry, but what are the characteristics, what are the behaviors that will make a company or an industry successful. And I think we've seen great evidence of both on the good and the bad side over the last few months. Industries that have been able to react very quickly, to pivot, to range. And those are the ones that are going to be resilient. Those are the ones that's going to come out, even though you might not necessarily know exactly what it is that they're going to be doing in future, but where you know that the way they are doing it is what's going to be resulting in their success. And I think from an analytical perspective, it's much more of those behavioral aspects, sort of understanding how management thinks and how they respond in a time of crisis, rather than for us to try and be very specific about the numbers that we expect to come out of this period.
Yeah. Stuart?
Yeah, the question's interesting. The example of alcohol, of course, is a policy issue, right? So one of the key factors to consider at the moment is really understanding the policy and the politics that's driving policy decisions. We would hope that policy decisions are driven primarily by the logic and evidence, but some of these decisions are clearly made for other reasons. And we've seen huge demand on the buy side for insights into what's happening at the policy level. Help us understand who is making the decisions, what kind of evidence are they basing these decisions on, how are these decisions made, in order to try and anticipate what types of lockdown, what kind of industries might be shut down or opened up over time. And that's been a really active and important area of research. And it's unfortunately the case that a lot of policy decisions have not been made with full understanding of the economic consequences of those decisions. So, we've heard from the alcohol ban, 13 billion rand of investment being pulled back by the beer companies and Consol Glass. In a normal sort of rational analysis, you tend to assume that policy makes decisions that optimize economic outcomes, but we're not seeing that happen in this environment. So it takes careful research to try and understand what the drivers really are to anticipate these kind of interventions.
Right. Mark, there's a question that's just come through now, and it reads, would you say the growth of retail investors is a threat to institutional investing as more cost platforms emerge and more real-time data is accessible to everyone?
Interesting question. I suppose every market will be quite different. So South Africa is known to be largely an institutional market. I can get the numbers wrong, but I think only 7% of the average trade on the JSE is from retail investors, so majority still largely institutional. It would be very different in Egypt or Turkey, where probably 90% would be retail investors. What is an interesting point as well is to what extent the global retail investors have taken a very different view of the outcome of COVID than the institutional investors. Yeah, so one argument brought forward why the valuation multiples in developed markets are so high is because of the enormous inflow of funds and investment by the retail investors. So almost looks like we have a different point of view about how the COVID is going to impact the world and the earnings of companies between the retail investor and by the institutional investor. From our team's perspective, we're actually quite concerned for the next few months because valuation multiples in developed markets are quite high. And you got quite a grinding earnings seasons coming up for the next 1 or 2 reporting periods. Yeah, so we actually mentioned to investors that we probably need to be quite careful. There's going to be a reality check coming up in the next few months about what the earnings delivery is going to be and how quickly, to Rena's point, can the economy actually support the earnings recovery going into 2021 and 22.
Right. Stuart, I'm going to bring this back to you. There's been debate over the impact of MiFID II in the marketplace. And this question that's just come through now says, how much MiFID II compliance or alignment do you see in our local market in terms of separating execution from research spend?
Yeah, it's a good question. And as part of the survey, we ask the buy side to tell us whether they're doing this. And the answer is that the minority is. I don't have the exact figures to hand, but they're in our report. Less than half of the market is applying a strict MiFID framework and separating execution. And I think something like 27%, only 27% are charging research to their central P&L rather than allocating it against client costs. So the South African market has made some movement towards MiFID II, but certainly not all of it. At the same time, we're seeing some rethinking on MiFID II in Europe at the center. In part, that's been supported by the COVID crisis. Europeans are recognizing that some market inefficiencies have crept in because of the decline in research coverage, particularly of smaller and medium cap companies. There's been a herding effect of analysis focused on the large companies, and asset managers have cut down on the number of firms they obtain research from, which means less coverage overall. So there are debates at the moment about, for instance, reintroducing research up to small and medium-sized companies as part of bundled into fees along with execution. So there's some walking back of where MiFID II has tried to change the market, and that's going to influence the South Africans. In fact, year on year, we've seen a decline in asset managers' adherence to the MiFID framework between last year and this year. So it does have an influence as to into practice, this kind of second thoughts about MiFID II that we're seeing.
Nerina, your thoughts on these unintended consequences?
I think it's a very, very well-made point that these are unintended consequences. And in South Africa, really, we are on the receiving end of so much of the global regulation. And whether you're looking at organizations such as IOSCO or any of the global regulatory bodies, we often, and also as a member of G20, South Africa actually is required, due to its ownership or its membership of those bodies, to apply these regulations, even though it might be very inappropriate for us. And so I think where we see these unintended consequences being manifested in those big developed markets where they come from, it's going to be to our benefit because we have not yet fully implemented it. I almost want to say fortunately not, and therefore the impact of the unintended consequences is a lot less so in our case. One of the things that I did find very interesting in this year's survey is the rise of the independent analyst. And I'm particularly appreciative of the fact also that where a lot of the analysts that were up for the awards might have been put forward by their big sell-side firms, there was the opportunity for buy-side also to actually acknowledge and identify independent analysts. Now, those are ones that absolutely there's no link between execution and research. And I think it's incredibly important that we support this independent analyst environment as well, because I think there's much better purity in terms of research, ideas, quality, and so on. And it's changing the landscape in which we are doing research and the way we are actually paying for that research within our institutional investment markets.
Yeah. Mark, your thoughts on this MiFID II compliance and alignment? Are you seeing much of it?
Yeah, we very much welcome a review of the MiFID II rules that have emerged and indeed resulted in unintended consequences. The one being that I think it's generally very difficult to put a price ticket on content, on research overall. It's quite difficult because it depends on the position of the client and how they're going to execute on the idea of what the value is. Yeah. So I think the review would be very welcome because certainly it has resulted in a much reduced coverage universe of most of the brokers. So the way we as SBG Securities responded to it has been to introduce what we call CCR, corporate commissioned research for the mid and small cap companies, which is actually a service offering where the corporates are paying an annual fee to be covered by a separate group of a team that we have. So it's not the independent analyst, it is a corporate commissioned team of analysts that then cover the company. Because we established over a longer period of time that there's about a 15% on average value uplift if the sell side has substantial coverage of a mid and small cap company. And that's, of course, is quite obvious that you need to have a corporate profile, you need to have an earnings consensus number in the market to reduce the perception of risk to the asset manager community. And quite often our clients telling us, sometimes we like a key investment story of a mid and small company, but we don't have the capacity to actually get to grips with the investment opportunity. So for us, what we call CCR has been very beneficial and has resulted in substantial uptake in the South African market to continue to have coverage under the mid and small cap space.
Right. So we've got about 6 minutes left, and I suppose let's just see if you can take this conversation a little bit more forward and think beyond our current situation. And Narina, I want to ask you this. Is there a risk that a successful corona, virus vaccine could unsettle markets by either, sparking a sell-off in bonds or rotational tech into more cyclical stocks?
I would hate to think that a successful vaccine is a negative disruptor in markets. So yes, it may, although it might therefore cause a shift in allocation of assets across asset classes and across the geographic region, I would like to think that it will have more of a positive impact rather than a possible negative impact. I think one needs to try and identify what was the basis also for the shift into, say, bonds, for example, away from equities. And I think it went way beyond just the impact of corona and COVID, and much more towards the impact of monetary policy as we see it around the world, the deflationary forces that are at play. And a lot of those predate COVID. So I think the reason for the shifts that we've seen needs closer inspection, which will give us a better idea in terms of what the forward-looking idea and what might happen in terms of a vaccine or the path forward for COVID, how that might influence asset allocation decisions at the overall asset class level.
Right. Mark, your thoughts as to how this plays out, and perhaps you can, let us know from a South African perspective, because things aren't looking good at all right now. And some people are reluctant to look at the next unemployment figures or the next GDP figures. It's just one of those where you want to, look the other way. Yeah.
So there's two ways, I think, that a population deals with the pandemic. It's either you're going to learn how to live with it, or you rely on a effective vaccine. I'm not a health expert, so I don't know what the probabilities are of finding an effective vaccine that's trusted by the population quickly and shortly. If that were to happen, I do think that's going to be very positive for the cyclical companies. So we've done some analysis where we looked at mean reversion. If we take the average valuation multiples over a business cycle of 7 years and you apply it to defensive earnings into 2022, you get certain sectors in South Africa that could substantially re-rate. And the sectors that came up in our kind of, let's call it screening, were the consumer sector, particularly the discretionary consumer sector. You're then talking about the clothing retailers, for instance, gold as well, which of course is running at the moment already. Oil and gas comes up, and then banks and real estate. So certainly a vaccine and an effective rollout globally, including in South Africa, would have a substantial effect on sector rotation.
Right. Stuart, I'm going to bring out the journalist in me. If I understand it correctly, you may have done a course in pre-colonial African economic history, I think at the London School of Economics. And there's a lot to be learned from, our mistakes right now. What can we take away from this? I mean, we were saying that, there's some elements of this that kind of resemble 2008. Some are very different right now. But what do we pick up and learn to, make better decisions? Because, I don't know how to explain it, but there's so much that we could learn from at this particular stage.
Every crisis by definition is different because, we're good at fixing our systems to not repeat the same crises. I think this crisis has got elements from a financial sector point of view from 2008. We're actually quite resilient because of the decisions that were made post-2008, increasing capitalization levels in banking and liquidity and so on, has meant the financial system has so far remained resilient. But there are also elements of the Great Depression here. The demand shock to the real economy is enormous. There are elements of the 1970s oil crises because of the supply shock to the real economy. So you can look throughout history at all of these crises to learn different elements of how this crisis is going to affect us. But fundamentally, there is just huge uncertainty in a way that we haven't seen since maybe the 1918 Spanish flu pandemic, where we just don't know what the course of the disease is going to be. Could there be an effective vaccine? How quickly could it be manufactured? How quickly could it be rolled out? How much immunity would it provide, if it can be done at all? And these questions simply can't be answered at the moment. And it's going to take us at least 12 months to get to some real answers. We don't know what the seasonal cyclicality, what second waves we could be experiencing in the infection. And that's just the health. We don't really understand the causal feedback mechanisms into the economy as well. We talked about the overall markets having recovered in a V-shaped recovery. Mark's made some really important points about whether that V-shaped recovery is going to be supported by the earnings information that comes out into the market of what the real economy is actually doing. The real economy, we don't really know fully how it's responding to this environment. So all of this uncertainty. So the right decision making you've got to do in this environment is to think through the scenarios and ensure that you're resilient for those scenarios, rather than trying to probability weight scenarios and then backing those scenarios, because probabilities in this environment is not really a logically feasible thing to do.
I'm going to squeeze the last 30 seconds, and Narina, perhaps you can take this question quickly. And it says, with a shift in consumer behavior from wants to needs, is this the end of the luxury sector, or are the days of the luxury sector numbered?
I don't think so. Unfortunately, the human element is always still there, and there's a strong aspiration element to luxury goods sector. So no, I do not believe that it's the end of the luxury goods sector as we see it. The end consumer might look different in the future than it did in the past, but I don't think luxury goods is going to go away anytime soon.
All right, guys, we've reached the end. Thank you so much, for engaging, and thank you so much to all of you who have asked your questions. Do remember that we do appreciate your feedback, so you can give us feedback next to the chat session. Let us know what you thought, and thank you so much, Stuart Theobald from Intellidex, Mark Termors from Standard Bank SBG, and of course, Narina Visser from CFA Society South Africa. From myself, Nastassia Arendse, thank you so much, and goodbye.